We in our team are global macro top-down investors. And what we look for is when different markets are pricing in different economic outcomes. And you're really seeing that right now in fixed income. If you look at government bonds, while there are some interest rate hikes priced in over the next few years, there's very little priced in over 5 to 10 years from now. So in other words, the market seems to be pricing in a moderate depression with very little potential for longer term inflation. As it happens, that's something which we think is likely to occur. If you look at corporate bonds, on the other hand, the credit spreads or the extra yield you get on a corporate bond over a government bond is extremely tight historically. So in our view, it's a market that seems to be pricing in a very strong economic outlook over the next 5 to 10 years, which is something we think is a little bit too optimistic. While you look at emerging markets, that's an area that we think within global fixed income is very cheap. Historically, you see emerging markets tend to move in line with the global economy and in line with commodity prices as well. And yet in the last 15 months, they've really lagged. So for us, emerging markets looks to be an interesting valuation opportunity. Historically, fixed income used to be all about generating high levels of income, but now we're in this low yield, low interest rate environment. We feel that the role of fixed income is much more about being a diversifier or being uncorrelated to riskier assets. And if you can fulfill that role within a multi-asset portfolio, fixed income can help improve your risk-return ratios. Within fixed income, you can get very different behavior of different parts of the market. For example, government bonds tend to be uncorrelated or even negatively correlated with riskier assets. High-yield corporate bonds traditionally have a high positive correlation with riskier assets such as equities. Investment-grade corporate bonds tend to sit somewhere in the middle. And by blending these together and using other areas such as currencies or emerging markets, we are trying to deliver a diversification where you can have an uncorrelated return stream relative to those riskier assets that you may already own. Government bonds are often negatively correlated with equities, while investment-grade corporate bonds tend to be uncorrelated. High-yield corporate bonds with a higher yield often are more positively correlated. And that's a general rule for fixed income, is that the larger the yield, the more risk on, if you like, the higher the positive correlation with riskier assets. When you're building a global fixed income fund, you need to be aware of whether your fund is uncorrelated or not, depending upon what you own. And I think another really important point about fixed income is that the yield on the bonds that you own is not the same thing as the expected return. Sometimes over the global economic cycle, actually it's the lower yielding bonds that give you the best capital gains. Other times it is the higher yielding bonds, normally in the good times, that give you the strongest capital gains. So for us, flexibility is key. You need to have a macro view of where we are in the cycle and where we're going, and then try to fill your portfolio with positions which benefit from that particular stage of the economic cycle while maintaining a diversification benefit within your funds.